What's up, guys? Thank you for tuning back in again. I hope you're all doing good and invest safely. One of the greatest investors of all time had his annual shareholder meeting yesterday, and hundreds of thousands of investors usually watch this event and listen to the words of Warren Buffett. These few hours of talk are basically combined knowledge of decades of investing of Warren Buffett and Charlie Munger, who are both above 90 years old and have combined over 100 years of investing experience. So these guys really know what they're talking about. If somehow you have not heard about these two guys yet, these guys own a holding company called Berkshire Hathaway, where they basically buy and sell businesses and stocks of other companies. And this company has outperformed the overall stock market over the last 50 years with an average annual return of over 20% compared to the overall market, which did about 10.2%. Of course, their company Berkshire Hathaway is public as well, and you can buy shares of their company on the stock exchange if you feel like. This is a very quick overview about their portfolio. They hold private companies such as Dairy Queen, for example, as well as public companies like Apple in their portfolio. Apple is by far their largest position and basically their only big tech company. Yes, they have started to buy some Amazon shares in the recent years, but only very small percentage. And Buffett mentioned before that it was his fault to not buy into these promising tech companies earlier, like Amazon, Apple, and you name it, because he had always a pretty tech-adverse investing strategy. That at the latest changed with their big purchase of Apple shares in 2016. So I watched the shareholder meeting of Berkshire Hathaway yesterday, and I now want to share with you one of my favorite moments of that event, where Warren Buffett talks about tech companies. And I find it particularly interesting because I'm myself investing a lot in these big tech companies, because they're not only the biggest companies in the world and one of the most profitable and still fastest growing companies. So I think it's pretty interesting to see what one of the greatest investors of all time has to say about these companies.
What's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks gaining 50%, 100%, 200%, etc. in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. But we don't, at least Charlie, I feel that I understand Apple and its future with consumers around the world better than I understand some of the others. But I don't regard prices, and that gets back. It gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter. If interest rates were 10%, valuations are much of it. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. It's very interesting. I brought this book along because for 25 or more years, Paul Samuelson's book was the definitive book on economics. It was taught in every school. And Paul was the first Nobel Prize winner. Paul became the most famous of his time. So I looked up in the back under interest rates. I looked for negative interest rates. There's nothing there. So I finally found zero interest rates, and Paul Samuelson, brilliant man, after a couple of hundred years we've had of kind of studying economics, basically, he said that you can conceivably, technically, you can conceive perhaps of negative interest rates, but it can't ever really happen. And that was, in the 1970s. This wasn't back in the dark ages. And this was and no economist wrote up and said, this is a terrible line to have in a book or anything. And here we are in this world where we had zero interest rates last week this week on a four-week note. And Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get 20 million. Imagine your wages going from $15 an hour to 20 cents an hour. So it's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. Those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we're sending out huge sums. I mean, the President said it on Wednesday, 85% of the people, we're going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. Trillions don't mean anything to anybody, and $1,400 does mean something to them. So we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we?
Yes.
So Buffett basically says that these companies are not as expensive and overvalued as a lot of people see them right now. On the one hand, because they have such a high return on capital and need so little capital to operate. And on the other hand, we have the historically low interest rates that make stocks just such an attractive investment at the moment. Buffett and his partner Charlie Munger also think it's one of the most interesting times they have ever seen in the economy. And they are very cautious to see what the outcome of this crazy experiment with these historically low or even negative interest rates will be. However, if Warren Buffett thinks that these companies are so great and have such good valuation still, why doesn't he buy into most of them, like Microsoft or more of Amazon or even Tesla maybe?
Cook was underappreciated for a while. He's one of the best managers in the world. And I've seen a lot of managers. And he's got a product that people absolutely love. The part it plays in their lives is huge. I use it as a phone, but I'm probably the only guy in the country. I sold some stock last year. That was probably a mistake. You thought it was a mistake too, didn't you, Charlie?
Yes.
Yeah. I could only do so many things that I could get away with, Charlie. And I kind of used them up between Costco and Apple.
He's pretty much just doing the opposite. He's piling up more and more cash, and also during the crash last year in March and April, he didn't really add a lot to his positions. Like, he didn't do like crazy big purchases, which we would expect in such a dip. The shares he's buying the most at the moment are basically his own. He's doing a lot of share buybacks, which indicates that he thinks that his stock is quite undervalued. But maybe Buffett also has an eye on major indicators like the Buffett indicator, which is actually called the Wilshire GDP indicator. that normally stands around 80 to 100% in a fair valued market. And as you see in this chart, it is at a mind-blowing 235% right now, which is pretty dangerous and makes me fear a bit about what is going to happen. Also, other indicators like the Shiller PE ratio, which is also widely used to value the stock market, is nearing all-time highs. And you see here, every time it hit like this peak, there was a major crash or a major recession in the stock market. But as Buffett and Munger also said, this experiment with these historically low interest rate has really never happened. And my conclusion on Buffett and Munger's acting is that they probably also don't really know where it's going to go. They probably think the best will be just to ride it out, even if there's a crash, to just own good businesses that produce good cash flows and just buy and hold, right? This is his basic strategy. And you see they are really hesitating to invest like a lot of money right now because, yeah, we could be at the peak right now and basically see no new all-time highs for the next few years. Personally, I'm also not investing like a chunk of money right now into the stock market. Here and there, when I find a good deal, I may add a little bit to my existing positions, but I'm not really building like a huge new position at the moment. And I'm also selling a little bit out of my short-term plays, mostly like call option plays that anyways expire this year. I'm gonna probably reduce them to zero because if the stock market drops, then the options will drop way quicker. So I still want to lock in my profit here. The whole video of the shareholder meeting you will find below. If you have not anything planned for tonight, just grab some popcorn and watch the shareholder meeting. I hope you found this video insightful. If you did, I would appreciate a like, and feel free to subscribe to my channel for more videos about investing and entrepreneurship. See you in the next video. Thank you for watching, and bye bye.